Hi, Darko. We've spoken about taking money in as a company. What about investing into other companies? How long is the process take and what does it look like?
Well, for when you're considering investing into companies, you need to first know why exactly you're investing. So you can have reasons like pure financial return, or a bit more strategic reasons because you want to get a certain share in a company that may be strategic for you. You want to have a foot in the door for potential further or future acquisition and so forth. Um, Either way, when you are considering that, it's probably going to be a process that will last for a bit. That will include not only investment itself, but also deciding which companies to really invest in. So to really properly scouting for the right targets. And that process will last at least 6 to 9 months or up to 1 year or even longer.
And how long should you expect your money to be trapped in the company for? When do you think, on average, you can see a return?
Again, it really depends, but if you're investing in early stage companies, you need to basically count with at least 5 to 7 years before you will be able to see the returns. If you're investing in a later stage companies that are already profitable, established in the market, and so forth, you may see at least some returns paid out via dividends, which basically means that you can start seeing basically benefits out of that immediately. And if you're investing for strategic reasons, you might be able, because of your investment, to influence the decisions of the company that you have invested in and basically generate returns not directly through the company, but through synergies that you might explore as partners and so forth.
You mentioned investing in early stage companies or later stage companies. In general, where do investors get the best returns?
Well, if you talk about financial returns, it would definitely be early stage companies. But early stage companies can only swallow a certain amount of an investment. So if you would throw tens of millions into a very early stage company, that company would not be able to properly deploy that amount of cash, which means that also the returns on that would not be phenomenal. Hence, if you want to see a return on a significant amount of cash, couple 10 million, you would need to find targets that are more later stage that can actually use that kind of money and deploy it in the right way to basically generate shareholder value in due time.
Venture capital funds invest in companies all day long, it's their job. And you hear all these stories that even they only get 2 out of 10 of their companies returning them a profit. What can you as an investor do to decrease the risk that the company you invest in is going to fail completely?
Well, you want to do your due diligence properly first. And that due diligence is not only connected with financials and legal setup and similar, but even more so, you want to understand what drives the people behind the company, the founders, the management, how they react in certain situation, how they think about both present as well as the future, and so forth. And with that, ultimately, you may decide for those investments that generate proper returns. I mean, from my personal experiences, by doing all of that, plus being able to kind of spot the right ideas in the sense of whether the idea has a proper potential in the market or not. From my, let's call it, history of investing, I've managed to basically majority of my investments are alive and kicking, and I've recently had few exits, which kind of confirm the approach.
Some people say that an exit strategy just constrains a company from taking advantage of opportunities in the future. Other people say disciplined investing is about knowing your exit strategy right from the beginning. What's your experience been?
Well, I would not say that you need to think about exit strategy with the investment itself, especially not if you're investing in an early stage company. Now, why not? Because you should really be concentrating on what kind of milestones the company will be able to achieve with the investment that you are making. And if the company will be able to achieve those milestones, which usually include growth, finding the right customers, basically generating revenues and similar, you will be in a position to then properly plan and think about an exit. But if you're investing in early stage companies, I would advise against focusing too much on what the exit strategy itself is.
Darko, thank you very much. I look forward to our next talk.
Thanks, Anton. Interested to learn more? Visit www.dg180.ch and get in touch.